Hi, I wanted to welcome you to the Divorce Planning Podcast. I'm Carri Goldring, and I'm in the mortgage business, and I do planning pre-divorce for people who are either going to refinance their home, do an equity buyout, or plan to purchase a new home and make sure that everything in the divorce decree is worded properly and the numbers in the planning is taken care of so that you can go through the underwriting process smoothly. And I would like to introduce you to other people who are interested in the divorce planning process so you can get a real education of what's involved. Hope you enjoy.
Hi, Julie Quick. I want to welcome you to my podcast. Thanks for joining me.
Thanks, Carri. I'm excited to be here and talk to you some more.
I am too. And I want to remind everyone that you're a certified financial planner.
Yep.
You work in all different types of divorce. And you and I were talking because you and I look at things a little bit different. So sometimes people were wondering, well, why do I need both of you on the case? And I thought maybe we could just talk about the differences because your eyes are looking at things from, I'll let you explain, but from a financial budget perspective, and I'm looking at things from a can you qualify for a mortgage perspective. And unfortunately or fortunately, we don't have the same eyes.
That's right. That's right. I think there's just different ways to view the information based on what is trying to be accomplished. And so, yeah, we had this great idea to kind of talk about how we look at the numbers differently, and in some ways similarly. So it's not all different, but yeah, I'm excited to have this conversation because I think it's really an important one that people need to know about and to hear about.
I do too. And you know what it reminds me of, kind of when you're a self-employed person and you're going to an accountant and they're like, okay, we can claim all this income because this is what you make and you can pay taxes on it, or we could go through all the guidelines and figure out what write-offs you have and how we can diminish your income to pay less taxes. And it's not that they're doing anything illegal or wrong, but there's different ways to look at it.
Exactly.
And
exactly.
I kind of feel like if someone takes that approach, I think they'll kind of get where we're coming from.
Right. And I think it comes down to what is the end goal. And sometimes our end goal is slightly different. Not that they're opposing, but just different.
Right. Okay. So tell me, when you're working with someone and you're talking to them about their income and their budget, can you kind of just summarize and go, and I don't even know if it makes a difference what type of divorce they're doing, but I'm curious what you do and how you look at it. And then I want to tell you how I look at it after.
Yeah, absolutely. So there really isn't, when I'm working with somebody to do what I refer to as a spending plan or a budget, there's no difference in my approach, whether it's a traditional divorce, collaborative divorce, or mediation. The goal for that exercise is to understand, first of all, what is your take home pay available to actually spend? And then what are those expenses? And I do it in a prospective manner. So we are trying to look ahead and anticipate what new expenses or new or changes to my expenses or changes to my income should I anticipate. So it's a very forward looking exercise. So when I'm looking at income, I'm looking at all income, really, W-2 wages, or earned income, I would say. So W-2 wages, any commissions, any bonus pay, anything like that. Now, when I'm going through the exercise, my instruction to my client is let's try to be let's err on the side of caution and let's be conservative in our assumptions. Because again, at the end of the day, I'm trying to identify what is your take home pay available to spend and what are your expenses. So I don't want to overinflate that income and potentially show a surplus that may or may not be real. So what we're trying to understand is, can this person afford their expenses moving forward?
What if someone is putting money in an HSA account or a 401k account? Do you say that's like a variable number that we can play with, or are you always trying to maximize that?
That's a great question. I start with what they are currently doing. So
Okay.
I will actually look at their pay stub and look at what are their gross wages, what are all the deductions that are being taken. I'll even ask them if they're the spouse that's carrying all the health insurance. What are your other health insurance options so that we can identify, okay, once your spouse drops off when you're no longer married, because they cannot be covered, what is it going to cost to just insure you or you and the children? So again, this is a forward-looking exercise. So I'm trying to anticipate what your expenses are moving forward, income and expenses moving forward. So I will deduct all of those deductions that come off the paycheck. So if they're currently contributing to their 401k, that gets included. If they are contributing to an HSA, all of that is factored in. Now, one thing I do different is they have taxes withheld from their paycheck. I will do a tax projection. So assuming their new filing status. So if they're currently married filing jointly, I will run their income under either single or head of household, whatever the case may be, to understand, okay, what are those taxes going to be moving forward? So I then use that number to identify, okay, if this was post-divorce, this is what you would have as take-home pay after taxes, after deductions. This is what you have available to spend. Now, I always include the caveat that unfortunately, this kind of pains me to say this, but 401k contributions in divorce are considered a discretionary expense. So that could be something we go back and adjust down if necessary, if we need to make their budget work, or if it is precluding them from being able to maybe pay support to their spouse or child support. So it's not a guarantee, but we do include it initially with the caveat that we may need to come back and adjust it.
And then are you suggesting at some point you need X number of dollars of support because otherwise you're never gonna afford yourself? Or
Not necessarily. What I show is, okay, here's your take home pay, here's all your expenses, and we can walk through the expense exercise in a minute. And then what's the surplus or deficit? And a lot of times there is a deficit. And so that kind of shows what the need is. Now, usually we haven't had the discussion on support payments, whether it's a formula or, whether it's a spousal support guideline. So that's kind of a future conversation. Like we can add those numbers in as income once we know them. But mainly it's just identifying, okay, what's the surplus or deficit? Usually there's a deficit. And I present other options too. Like support might not cover all of this. So now that we've captured everything in one place, we may need to circle back and make adjustments.
oh
So
my stomach would drop.
I know by capturing everything, and my expense spreadsheet is pretty robust on purpose. I try to capture everything. I kind of set the stage, like nothing's guaranteed. Like this is divorce, people. Like more often than not, both parties need to kind of pull the reins back a little bit.
Right, it's so hard. And no one thinks of everything, right? Like when you're doing a budget, like no one thinks of you have to mail stuff or
Yeah.
ship things now,
Yep.
or you have to buy gifts or
Yeah. Oh man, I tell you what, people underestimate how much they spend on Amazon. Oh gosh, that's a huge part of the budget. Huge part of the budget.
I
So
believe
yeah,
it.
there's all kinds, and those little things people are so quick to, not always, but a lot of times people are quick to dismiss things like that. Oh, that's just a $5 subscription or whatnot. But those little things do add up and they can make a big difference.
I remember even trying to do my own budget and going through like all the things that you spend a year, like the lawn service or the snow service or the driveway that needs the asphalt and
Yeah.
all. I know when you try to really go through it, it's hard. It's a hard
So
assignment.
what I tell clients, because I have some people that get really in the weeds, they are super detail oriented and it can become very, very overwhelming. And so I would advise people, we're not shooting for perfection here. We will drive ourselves crazy if we need to factor in every single expense, the exact amount. But what I argue is if we get even 80% of the way there, you are far and above better off. Then the remaining 20%, you can deal with that. But I
Okay.
would venture that the majority of people don't even take the time to
Get
do
that
even,
detail.
yeah, even
I'd,
half of
I'd be
the
your
level that we're
detailed
doing.
client for sure.
Yeah, yeah, yeah.
Unfortunately, be
No,
like,
I
"Ah,"
love it. I'm a detail person, so
right.
yeah.
And we would have to be in our job.
Hmm.
So that is very, very interesting because when someone applies for a mortgage, I have to show that this is what they're currently receiving.
Hmm.
And our theory for underwriting is that it must continue for at least 3 years in order for us to count it. So child support on a 15-year-old wouldn't be counted because they're not going to get it long enough.
Right. Now,
But
does
if
that
they were
3-year
just,
rule apply to wages?
it applies to wages, but we're not allowed, we can call the employer and say, what's the probability of continued employment, which they
Mm.
do right before every single closing.
Wow, I didn't know that.
And usually the employer will say, it's good. And then we're good to roll. But if they say, oh, well, they put in their 2 weeks notice and they're not going to be working here longer, or we just sent, we had to lay off 20 people and they're one of the 20 people, we're not going to the closing table.
Yeah,
So
interesting.
we try to tell everyone, like, you can't change your job, your employment, how you get paid. Nothing can change through this whole process. And sometimes you get the person who says, well, I already have mortgage approval, so I quit.
Mm,
Well, no, 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 no.
don't do that.
Even
Don't
though
do
you have
that.
mortgage approval, until you get keys to your new house or the deed or whatever the case may be, you better keep things identically the same.
Okay, good to know. Good to know.
So that gets back. And then they also look at, so you're looking at net income.
Yep.
We're looking at gross income.
Ah,
So we'll look at 401k and all that other stuff and say, it's discretionary. If things get tight, you can always pull back. So we're not gonna care about it.
ah.
And we're looking at that gross number. So, and then we look at the average. So you have this is now your non-typical person, right? Like, it's very rare that somebody comes to me and say, I'm paid on a salary and this is what I get all year and it never changes. That is like an anomaly now, right?
Okay. Mhm.
But those people you take as is and you say, okay, this is your monthly income and this is what we're working off of. And everyone else says, I have a little salary, but I have bonus, or I have commission, or I'm self-employed, but I pay myself on a W-2. So depending on what the answers are and what they had last year, what their year to date is, we actually have an underwriting person that we send all this stuff to before they ever make mortgage application and say, here's all their income. You tell me what I can use to qualify them, because it gets so specific. And, we talk about like post-judgment orders, right? And the house always seems to come up as a post-judgment thing. Well, we have what's called post-closing things, where after we sell the loan to Wall Street, they do an audit and they come back and say, nope, we're not buying your loan because you calculated the income wrong. So our biggest post issue is income calculation, which is
Interesting.
why we have an underwriter now review. So I could do like my own down and dirty method, but usually as soon as someone's sending me pay stubs, W-2s, tax returns, I'm shipping them to an underwriter to review them, to
Okay.
give me an answer of what I am or am not using for income.
So the takeaway is, if somebody's listening to this and they've got a variety of income sources, their ability to qualify can vary, or the income that can be used to qualify could vary.
Right. Even if
Yeah.
it's the same income source, but it comes in a variety of ways,
Mm.
bonus, commission, they're getting mileage reimbursement, they're getting car reimbursement.
Okay.
The
What
teacher who
about,
gets paid 10 months versus 12 months.
oh yeah, that's interesting. That's interesting. Now, what about investment income? Do you ever include like dividends, interest
I
as
try
income?
hard not to.
And if I could qualify someone on just their income, I would much rather go that route. And then probably like you, so if you have somebody who's of retirement age, right? Or someone who's not, things are different. So if somebody has $2 million in the bank and they're younger and they're not paying themselves, right? Then it's just assets.
Mm-hmm.
But if I have an older person who's of retirement age and they have all that money in the bank, then all I have to do is divide it by 36 months and say, you could for the next 3 years, not saying that you should do it this way,
Right,
for
right.
sure, but I could do it this way in terms of qualifying.
Interesting. Okay. Yep.
And then when you have like spousal support or child support, they have, depending on the loan program, you either have to receive for 3 months or you have to receive for 6 months. And then it doesn't have to last 3 years from when it starts, but it has to last 3 years from the day we close.
Yeah.
And I have many attorneys who don't talk to me ahead of time, and someone will call me after their judgment's already done and they'll say, oh, my attorney knew that 336 rule, so I have income for 36 months. Great, we can't use it.
You can't use it. That's such a shame.
So it gets
Yeah.
tricky. But when someone calls me and says, I want to buy or I want to keep my own home, and we're going through the income and the qualifying, what are taxes on the house, what's insurance, I will say to them, you're short $2,000 a month or you're short $5,000 a month. So if this is going to work, where does that extra income come from? Does it come from support? Are you able to work more hours? Are you able to get a raise? But I can't have someone say, well, I'm just going to go get a second job. Supplement themselves, because when you're combining two employments, now I have to have a 1 or 2 year history.
Ooh.
So I could see that they didn't do that just for the sake of qualifying, and then they're going to turn around and quit.
Interesting.
So then they start asking for history. Same thing with being self-employed. They want to see, and it depends on, I think the rule is if you've been in business 5 years or more, usually I only have to look back 1 year. If you're less than 5 years, we look back 2. If your income's going up, we look at the last year. If your income went down, then we average. So we got all these little funky things, but it's kind of a look back and a look forward, but not the same look forward that you do.
Yeah.
Totally different.
So you have a totally different approach, a more, much more in-depth approach to income for qualifying for mortgage than I do when looking at someone's budget.
But then again, you're the one saying, what are you spending on clothes and at the doctor and to upkeep your house? And I do nothing. I'm just, what shows up on your credit report? What's the minimum monthly obligation that the credit report says, not counting student loans, because that's a whole nother ball of wax. But I don't count utilities. I don't count the grocery store. I don't count what they put into the 401k, where that's a huge part of what you're doing. And for budget purposes, it really should be a huge part.
Yes, we do a really in-depth review of expenses. I use some technology that they link their accounts to. So I actually start with a 90-day history of their actual expenses, which is so powerful as a foundation for filling out their post-divorce budgets. We use relevant data. A lot of the time, they are like surprised that they're spending a certain amount on a certain category. So it can be really informative in that way. But we use this historical information to then build their post-divorce spending plan. And like what I was saying earlier, the goal is, and I have to be very careful with my wording because I never want to insinuate with any of my clients that you're guaranteed to be able to maintain the standard of living. So, but we do capture everything, and some expenses are more discretionary than others. And we have a conversation like we might need to come back and revisit this and make adjustments. But I encourage them to do that from a place of prioritization based on their specific goals and values. So I'm not going to be like, oh, you need to completely eliminate the travel. You need to knock out your shopping, because some of those things may be very important to my clients.
Right.
I give
You have to
them
know
the
what the deal
option.
breaker is, right? You
Yeah,
have to know
yeah,
where the hard line is. And then what about like when you're first divorced, I feel like you always have to buy, like you're splitting up, I don't know, linens, you're splitting up kitchen stuff, you're splitting up
yeah.
furniture. So it seems like you always have all these really big expenses at the beginning just to almost remake yourself whole, but then you don't have to buy them again.
Yeah, so the spending plan that I do, I encourage people, this is recurring. It may be variable, like maybe you just make an insurance premium once a year, but it's recurring every year. Anything that is a special one-time expense, maybe we capture that on a separate sheet.
Okay.
A lot of times that's coming out of assets that are awarded to them. So I'm not factoring that into the spending plan, that it's being addressed somewhere else because it's not a recurring thing. But you're right, the upfront cost can be quite large.
Right.
Yeah.
It's like when you move to a new home and then you're rebuying condiments for your refrigerator and you're like, how is that $300?
Mm-hmm. Mm-hmm.
I
So when
remember
I'm
moving
doing
the
the
kids to college and it's like you had to just buying like all their spices, oils and
oh
condiments. And I'm
gosh,
like,
yeah.
who thought of that?
Yeah, yeah. So that's the level of detail that I think we can get really lost in the weeds and very, very overwhelmed for some people. So those are the things that we say, okay, maybe we have, you leverage some of the assets that are awarded to you for those kinds of expenses and just kind of remove that burden from the recurring day-to-day expenses.
Right. And then the other thing that you and I realize that we look at different is the liabilities and the assets. We had something come up with a car lease.
Yes,
Remember?
yes. Uh-huh. So I do not include the remaining payments of a car lease on the marital balance sheet. So it's not considered a debt of the marriage that gets divided. Whereas you very much include that in as a debt payment for qualification for a mortgage. So that is kind of a different way. I view it as you're paying for the use of something that you don't own. So it's just like it's like paying for your gas bill, or it's just kind of it's an expense and it stays on the expense sheet. It's not on the marital balance sheet.
Yeah, that was an eye opener for me. And
Yeah,
then we look at leases and car payments different because a car payment, we kind of look at it as, oh, once you pay off your car, you can choose to just keep your car without a payment. And then no one pays attention to the maintenance part of it. But if it's a lease, even if you're on your last lease payment, the assumption is you're going to get a new lease. So you're always going to have this as a debt.
interesting.
And if you have an installment loan and you have 9 payments or less left and you have enough money and assets in the bank, I can most of the time say there's enough money there to pay the car off. So let's not count it as a debt, but
Interesting.
never
Okay.
on a car lease.
Okay. That makes sense. It's not too dissimilar from how I think of a car payment. So if a client has a car payment, you're right, they will eventually pay it off. But my thinking is as soon as you are no longer paying a bank, take that money and put it in a bank account for that eventual car replacement. So with that kind of line of thinking, it's like the client will always have a car payment, whether they're paying a bank or they're just paying themselves to purchase a new one down the road. It's always there, or paying for car maintenance for that matter. So
Right.
that's kind of how I view car payments.
All right. And then what about student loans? I have a feeling that's going to be a weird one too.
Well, I just I have a section on my spending plan sheet for all debt payments. So whether they're making like credit card minimum payments, student loan payments, any other loan, like maybe just a consumer loan. I just capture that monthly payment so that that's reducing their take home pay, and that's the extent of it. Now, this is just for their spending plan. If I'm doing financial projections out into the future, then yes, of course, those payments will eventually drop off and they will no longer need to pay those. So those I will illustrate a little bit differently if I'm doing financial projections, but I just capture the payment on the spending plan and that's that. Again,
And
we're
you
just trying to
use
get,
a minimum payment.
I use, it depends on the client. If they're making the minimum payment, that's what I use. If they are paying more than that to try to knock it down and they've been consistently paying that, I'll include that with the understanding that if we needed to knock it down to the minimum payment, we could. Yeah.
Okay, and on credit cards, we always use the minimum, but student loans, even if they're in forbearance or deferment. So if I see a payment on the credit report, I use that payment. If I don't see a payment on the credit report, I'm taking either 0.5% or a full percentage of the balance and calling that a payment. And that again depends on what type of loan. They're Fannie Mae and Freddie Mac, both conventional, but they both have different rules of how they handle
Got it.
student loan debt. So sometimes that's a killer unless you're the doctor, then they have special doctor loans where you don't have to count student loans all the time, or they have their own little formula for how you count them.
Yep. Yep.
It gets so tricky. So maybe this will help people understand why we're both involved, because somebody has to be able to pay their bills in the future. And someone also has to be able to qualify for housing to go live somewhere.
Yeah. And honestly, Carrie, I think sometimes the more successful cases are when you and I are working collaboratively with the client. And because there's a lot of times where I'm like, Carrie, how does this count for the qualification? Because I can't remember.
Nor should you.
Yeah, nor do I want
Right.
to. No, so that works really, really well. Now, I want to bring up two property taxes because I know
Oh, yes.
we deal with that somewhat similarly, but not quite. So how do you deal with property taxes when qualifying somebody for a mortgage?
Okay, I'm going to explain them first because property taxes are really tricky in Michigan.
Okay.
So property taxes go off an assessment from the tax assessor, and the tax assessor goes out, even though they don't really go out, 2 times a year. They go out June 1st and November 1st, every single year, reassess your property. If you're not a new owner, they're not allowed to increase that assessment more than 5% a year. So on the records, it could show your house is worth more, but they're not allowed to tax it for more. So you're always getting this reduced tax if property taxes are going up a lot. So when someone's refinancing, they get to take advantage of those lower tax assessment taxes. So it is what it is. Whatever you pay in taxes, I look at the last 2 tax bills, that's what I'm assuming you're paying going forward. Someone purchasing a new home, I can't project what the assessor is going to assess the house for in terms of qualifying them for a mortgage. So the only thing I can do is use current taxes. So once in a while, they're buying a home that didn't use the homestead tax break because they're buying someone else's second home or investment homes, and maybe they moved in a year ago, so the taxes are higher than what they're going to pay. Then I have to use the higher one. If there was a seller that lived there for 20 years and their taxes are really, really cheap, and then this new person's going to move in and now they're going to go up astronomically, I use the really, really cheap. So someone can go to buy 2 houses right next door to each other, and I could use 2 totally different property taxes. Now there is a website that you could go to that says, okay, I'm buying in this county, in this school district, this is my assessed value, what are my taxes going to be? So it's something we talk about just so someone at some point in the future knows they're going to pay a higher amount. At some point, they're going to get a letter from us saying your escrow account is really low and we need to collect all this money and we're going to raise your house payment. I mean, people have to be aware of that.
Yeah, absolutely.
But it doesn't come up in terms of qualifying for a loan.
Got it. Got it. So when I'm working with somebody on their spending plan and they're talking about purchasing a new home, that is one of the first things I talk about. First of all, they want to kind of combine the payment, principal, interest, taxes, insurance. They want to include the entire payment. And I like to break it out. And I will go to that website. The state of Michigan has a property tax estimator. That is my best friend. And I go out there and I show it to the client. In fact, I have had clients who were, I had a client, she was like unsure which area she wanted to move to. And I showed her the impact to her property taxes. And that is what she based her decision on where to focus on, because
It
the
really
property
changes.
taxes really make a big difference. So I will make sure, like you, Carrie, I want people to know that I think when they're looking at a new home, the fact sheet of the home will have the current taxes, and it can be so misleading. To your point, if the previous owner lived there 20, 30 years, that's not reflecting the accurate tax. So I'm always estimating that future property tax once it becomes reassessed. So
And a
that's
lot
kind
of
of another,
realtors do not say anything about it.
no,
And there's many times that I mention it and you'll mention it. And then after they get the reassessment, I'll get a call. No one ever
they're,
told me the
they're still
taxes are coming,
surprised.
because you're already so overwhelmed and you can't keep all this information in your brain. And then when you just hear at some point in the future, this is going to happen, it's kind of like, I'll deal with it in the future.
Well,
But
buying a new
it's such a
home,
big,
yeah. And when you're buying a new home, there's so much outlay, cash outlay. You're buying new furniture, buying new supplies, like you were saying earlier. There's all these expenses going out, and you get this other bill. And you're right, no matter what people do to prepare you for it, it can be shocking. But I think that's a really, really important thing to be mindful of for people who are
especially
buying a
with
new home.
insurance going up so much. I know
Yeah.
even I've been in my home for a while, and even with just insurance going up, my house payment went up a lot this year that I wasn't expecting. So I know if I could have it happen to me, anyone could have it happen to
Yeah.
them. And
Yeah.
I know it's coming.
Yeah. Yeah. Yep. It can make a big difference.
It can make a big difference. Well, I feel like we covered a lot.
I do too. I do too. I think my big um, takeaway for folks is, what you can afford for a mortgage and what you want to afford can be two different things. And so I think leveraging the expertise of someone like you and a financial planner like me, and helping you really clearly articulate, what could you potentially be giving up by buying, this particular home, and might that sway your decision? So I think this was a really good conversation, Gary.
I do too. And maybe it'll help people understand that you can't really say, well, I need to know the maximum sale price I can qualify for. Because
Right.
buying a $350,000 house in one area and buying it in another house does not give you the same monthly payment. And we're always budgeting and qualifying off monthly
Yeah.
payment.
Wow.
Perfect.
Good stuff.
Thank you. I
Thanks,
appreciate
Carrie.
it. I always love working with clients with you, because I feel like we do get a good balance of everything to set people up for success.
I do too. I do
And
too. I think a lot can get lost in translation. And so when the three of us are together, it can really kind of help things go more smoothly. So always
I,
grateful for you.
yes, thank you. Hey, tell me real quick before we hang up, how do I get people in touch with you if they don't talk to me first and I give them?
Absolutely. Thank you. So Cultivate Financial Wellness is my post-divorce financial planning website. Cultivate Divorce Strategies is my before and during divorce website. So they can get a hold of me, get my phone number and email through either of those websites.
That's so wonderful. All right, Julie, as always, thank you so much for your time.
Thanks, Carrie. Great chatting with you.
You too.
I hope you enjoyed the podcast. I'm Carri Goldring, and if you ever have any questions regarding mortgage, feel free to give me a call or send me a text message, 248-420-4524. Hope you enjoy the rest of your day.